and welcome to Mortgage Solutions Television. It's a big welcome today to Matthew Wyles, who's Senior Policy Advisor to the Board at Castle Trust. It's our chance today to catch up with Matthew, find out what's been going on and get a quick snapshot of what's happening at the lender. So welcome, Matthew.
Thank you,
Vicky.
Of all. Great to be here.
Okay, well, first of all, let's cut to it. The lender launched in October 2012, forced to relaunch again in November 2013. What went wrong, Matthew, and how can you reassure advisors that things are right as they should be now?
Okay, so you're right that the business originally launched in sort of September, October 2012, and I arrived in about May 2013, and then, as you rightly say, we relaunched in November 2013. I think it's fair to say that the idea that Castle Trust conceived and which JC Flowers, the private equity investors, backed, is a really good idea. I think the problem was that they targeted the wrong part of the market and the propositions, frankly, were not fit for purpose. So when I arrived in 2013, the first thing I did was roll my sleeves up and reposition the business. So now the business is positioned primarily in the buy-to-let and in the high net worth space and not in the mass market first-time buyer owner-occupier space.
Okay, and so in terms of, do you feel there's still a job to do in terms of reassuring advisors that you've got the new proposition right?
We're not having any trouble convincing the new intermediaries we're bringing on that we've got the proposition right. I mean, our experience is that when the penny drops, particularly with the buy-to-let offering, which is the majority, not the vast majority, but the majority of the business we write, when the penny drops, they want to call all their clients. Because it's rare that a lender walks into your office with something that's so radically new and different that you need to call all your clients to talk about how it could help them. So we've got buy-to-let investors who have doubled the size of their portfolios using our product. So when they realise that you get richer faster working with Castle Trust than without Castle Trust, an intermediary gets very excited. Now, it's not all intermediaries. You know, some adopt themselves to it with much greater enthusiasm, but the ones who get it do a lot and, frankly, make a lot of money.
Okay, but it's a context issue as well, isn't it? Because when October 2012, the market was very different. We were sort of mired in the credit crunch at that point, and Castle Trust launched to address a very specific problem in that there just simply was not enough product innovation out there. So it was an offering that was very welcome, I think, and certainly launched to great interest. The question is, are you still relevant in this market where lending has certainly loosened up?
Well, it has loosened up. But that doesn't really impact upon our franchise. First of all, you've got to remember that we're the only lender in the market doing what we do. So in a sense, we have no natural predators. And all that you're seeing, frankly, I think there's going to be a lot of new supply coming into the buy-to-let market over the course of the next 12 months. In particular, you know, we can see businesses like Fleet Mortgages who are coming in with a brand new funding model. And I think you're going to see the standard first charge mortgage market, particularly in buy-to-let, hotting up. From our point of view, that's fantastic news because that's more new lenders to work with, and most of those lenders are going to be applying the same standard stress tests to determine how much they're prepared to lend against a given portfolio of property, and then we can come in and provide that extra equity on top to increase the leverage of the buy-to-let investor and his portfolio. So as far as we're concerned, it's bring it on. The more activity there is in the market, the more business we're going to do.
Okay, and just to recap as well, as I recall, most of your lending is second charge at the moment. The vast majority is high net worth and buy-to-let. So obviously you do have some unregulated and regulated products, and most of the people, in terms of repayment strategy, there seem to be three essentially. People will repay a predetermined proportion of either the increase in value of the mortgaged property or of the Halifax index, and in some cases you receive interest as well. Now, this is all quite innovative, breaking new ground, essentially, perhaps slightly out the comfort zone of lots of brokers. Yep. So how are you able to satisfy brokers that their customers won't be accumulating liabilities for the future?
Sure. Well, First of all, the vast bulk of the lending that we're doing, as you've already mentioned, is buy-to-let and high net worth owner-occupier. And in the case of high net worth, we're doing very large properties indeed. And actually, there's quite a shortage of innovative funding supply in that market. So actually, a very small proportion of our lending is caught by the regulatory ambit. So we do have a regulated second charge owner-occupier mortgage called the partnership mortgage, but frankly we don't sell a great deal of it. It's the product that the business was originally set up to do, but it's not the product that's really making the running in our offer. Once you've grasped that what we get paid when our loan is repaid is linked to the value that you've created by borrowing from us. So it's like having a joint venture equity partner who you can kick out any time you like. So if you make money, we make money. If you don't make money, we don't make money. So actually there's an alignment of interest between Castle Trust and our borrowers that you don't see in the conventional market. So you can't think of it like a simple debt contract, when it's much more like having a sleeping partner who comes in when you want them and leaves when you want them to leave. I mean, so you can pay us back anytime you like.
Okay, and that's a good point, because the exit route is often perhaps the issue in terms of understanding, not only brokers being clear on exactly how they explain this to their customers, but also perhaps, perhaps we can look at some case examples and talk about perhaps buy-to-let portfolio investments. Can you give me an example recently of how this?
Lots. So I mean, we're seeing new portfolios coming in every day. So at random, if I think of a typical case, we're doing a lot of lower yielding property in London and the southeast and the south generally, because as you know, very often low yielding property gets capped out in terms of its borrowing potential because they can't jump the hurdle of the stress tests at higher LTVs. So lenders will say that they'll go up to 75 or 80 or 85% LTV, but actually not if the rental flow isn't there. So we're doing a lot of stuff where relatively low yields, and so we're coming in with a slice, say, of 20% LTV above, say, 50 or 60, and that releases a great chunk of equity, which typically, they don't have to, but typically the investors are reinvesting in more property. So by the time they work out the benefit of that additional asset that they've put into their books off the back of the equity that we've released, if the market rises, they make money faster with us than without us. Okay. So that would be one example. How
long are they typically staying with you, Matthew?
Well, hard to say at the moment because we're a relatively new business. So the business really started to hum when we relaunched in November 2013. Right now we're getting very few redemptions, but what I would say is that we encourage customers to use us sparingly. And what I mean by that is, it's a bit like chili oil on your pizza, is that if you put too much chili on the pizza, you'll spoil it. But it adds interest and piquancy to it if you use it in the right quantity. And actually, we encourage customers to say, look, if the values rise or the rental values rise and you can repay us by using conventional mortgage debt, do it and go around again. Use our product at the sharp end of the portfolio, and when you can repay us with cheap debt, repay us and repeat the exercise.
Okay, Matthew, thanks very much indeed. It's been a very quick trot round, but your time has been appreciated today. I hope you enjoyed it as well. Thanks very much indeed for watching.